Hey, Heather, how are you?
Hello, hello. Hi, Paige. Thank you so much for having me.
It's so good to see you. Now, listen, folks, if you haven't been to a power conversation before, what I like to do is introduce people by reading all their stats, their bio, okay, their body of work in front of them, because I want them to know how incredible we think they are. But also I want to put to good use the copy that they probably wrote a long time ago and then maybe don't think about. Heather, I don't know if you think about all the flexes on a regular basis. So let me introduce you. Heather Hartnett, with a T, put some respect on her name, is a general partner and CEO of Human Ventures, where she has created one of New York's premier, okay, folks, premier startup studios and early stage venture funds. Since launching under Heather's leadership, Human Ventures has invested and co-built, okay, more than 65 companies with key investments including Reserve, which was acquired, okay, Current, The Skim, Tiny Organics, we're talking to Betsy for next month, and Tia Health. Those companies have grown to a combined 7.5 billion with a B plus in enterprise value and have gone on to raise over 500 million in additional capital from notable later stage investors. Prior to founding Human, Heather's venture capital career spanned various roles at firms including Lightspeed Venture Partners, City Light Capital, and Claremont Creek Ventures. She also led the development at the David Lynch Foundation, crystallizing her professional expertise in operations with the largest family offices and investment firms. So she's been in so many seats at this table. Heather is active in the community, serving on the leadership board of Tech NYC and Transact Global. Shout out to Transact, one of the most beloved spaces in the world, especially in our industry. And she's been listed as one of the 50 most influential women in America by Hearst Digital Media Publications, is a frequent speaker at TechCrunch Disrupt, and is a regular contributor to Forbes. She has wonderful articles. If you haven't checked them out yet, I did so in preparation, and what a joy. She's covering a range of venture capital topics there, so go get educated. And not only that, folks, not only is she an investor, and she's a writer, and she's a thinker, but she's a student of the changes in the landscape. And you're getting the freshest of gems after she's talked to over 600 LPs. And I know she's tracking them, folks, in a beautiful Airtable or Google Sheet or CRM or something, because she is on her business. So Heather, before we get started, I just want to check in. How are you today as a person? And what have you been up to this morning?
I'm so good. Paige, can I take you on the road with me? Can we just bring you? I should have just had you open up all of our LP conversations.
Put me on your shoulder, okay? Put me on your shoulder. I'm right there with you.
I'm so happy to be here, especially off of all of the energy from the All Raise conference. But the work that you're doing is so phenomenal. I can't wait to see it grow. And it's just been such a great energy for the whole ecosystem. So thanks for having
you, Heather. We got a stellar team here. So how are you, Heather? How are you?
I'm doing well. I'm actually almost 8 months pregnant, so I'm doing well. I'm final stretches here, but really in good spirits and good health. So I'm happy.
Well, not only is she here educating us, but she's also making a person right now. So she's
my newest human venture. Yep.
My newest human venture. The puns, they make themselves. All right. So let's get into our topic. A quick reminder for people who've just joined us. Don't forget to share your favorite advice, something that you've learned here today on social media. And then also remember, today we're going to be talking about emerging managers. So I want to level set for our audience. What is an emerging manager, Heather?
Yeah, I mean, this is one of my favorite topics. My last piece that I did for Forbes was the emerging manager needs a rebrand, because we in the industry we get classified as in alternative investments, private investments. You get kind of lumped in with private equity. You get lumped in with growth equity. Venture capital is a subset of a subset of a subset of a portfolio, right, for all of these investors. And so an emerging manager, the vernacular can mean so many different things. Whoever you're talking to, it changes. So I think right now the landscape is such where people have to really redefine what that means if you're an investor in this asset class. And for this purpose of this conversation, when I'm talking about an emerging manager, it's somebody who is raising or who has raised a fund, a venture capital fund, sub $200 million, and they're generally in their vintage of fund 1, 2, or 3. And I think more and more this is becoming a common nomenclature, and people have different definitions of the type of person who starts the fund as an emerging manager, whether you've spun out of a big name fund or you're a founding fund manager. All of these classifications are nuanced, and people kind of look at that. But that's when I talk about emerging managers, it's this specifically in venture capital, early in your fund cycles.
I really appreciate you level setting for us. And in case you didn't see it, folks, I dropped in the chat Heather's most recent article in Forbes. Definitely check it out. We're going to dig into it a little bit more. I want to talk a little bit about how the landscape has changed since 2015. And you and I were preparing for this conversation. You're like, I really want to talk about this. Can you tell us why 2015 is the year that you want to start from, and then what has changed about the landscape?
Well, then 2015 is when I started Human. And so it was really when I came into the landscape and I did my network map, my landscape map. And I thought at that point there were too many venture funds. I thought the ecosystem was already too saturated. Since that time, it has completely exploded. And COVID also had an incredible effect where location really didn't matter, right? And actually differentiated a lot of fund managers. Now there are Midwest funds as their core thesis of Rise or the Rest, or in DC, but really thinking about anywhere else other than the main cities. And, it really helped the New York ecosystem where I am as well. I think it's the fastest growing tech ecosystem. We're very bullish on differentiating your network. You can't gone are the days where if you're a venture capital fund, and see all of the founders, because the founders are just very, very spread out and talent and gems are everywhere. And so I think when people say we have a proprietary network or we were early in venture, or, the San Francisco kind of early PayPal mafia type feeling, that's one strategy, but now there's opportunity for so many different strategies to create value. So 2015, that's when I really kind of started to map the ecosystem. And I think we're at an interesting inflection point right now where almost a decade later, we have another whole kind of class and vintage of emerging managers happening.
I was telling Heather this earlier, everyone. I like to be like, yes, I'm over here typing. So I mute myself between my little speaking parts. But Heather, I actually want to ask you a quick question about when you came into 2015, you thought the market was super saturated. So when we were looking at our check writer research, which is where we study women in partner and above roles, we discovered that there were about 700 and some firms in 2017 when we started looking at that fell into that 25 million AUM plus group. And now it has exploded to 1,051 as of last year. So how do you feel now? There's a lot of firms out there. Do you feel like the market is saturated, or no? You're like, no, we need them. What do you think?
Yeah, I think from a founder's perspective, it's great to have more options. So I think emerging managers in general, I think by definition, they start because they see an opportunity that isn't being filled by some of the bigger firms. So I think it's a really good thing to have more options for entrepreneurs. And I also think that the smaller fund size for early stage venture is really important, both from a return standpoint, but also from just the finding and seeding and doing the work. It's a very different profile of a job to be an early stage emerging manager than it is to be a partner at a big fund and just write checks at that level. And so I think the ecosystem is better for it. I also think there will be a lot of consolidation. So there is definitely enough LP capital and appetite, I think, to service this. What's hard is that landscape is very opaque. Who writes checks? So we, as emerging fund managers, we have to fundraise, obviously. We have to bring in limited partners as our investors. We're money managers. So there are, categories of people who allocate capital allocators to emerging managers. That has now expanded, right? So it used to be, that any fund manager would kind of go to the big pensions or endowments and, people who could write large checks. Now the family office landscape is completely matured in terms of venture individuals. We've had multiple founders who have exits who come in and invest in funds. So I think that the pool of capital has expanded. We can talk about macro kind of shifts and, and challenges that has brought and opportunities. But in general, I think venture has just become a lot more mainstream, and people understand that this is a way to fuel innovation. It's a way to fuel growth. And if you're really smart about the opportunity set that you see and your thesis, there's capital out there for this asset class.
Let's talk about the macroeconomic trends that you're seeing. So why don't you dig into that for us?
Yeah, so I think the big change that's happened in 2023, obviously the Fed rose the interest rates are rising or increased. And so that makes it difficult for, or it just shifted, this asset class was definitely more favored when interest rates were low. Better to put your money there. Now, I think people who are actually investors in venture capital understand that these cycles come and go. And if you're in it for the long term, this is actually a very good time to find the people who will be the next big firms and be able to get your positions early in their fund 1, 2, and 3, which have been proven to actually be the best returning funds for most firms. So where the risk profile, gets a little bit less risky as the funds continue, fund 3, fund 5, fund 8, you can kind of see that repeated track record. So LPs like that. I think it still shows that in the beginning, 1, 2, and 3, you're proving out your thesis. You're never working harder than you have ever, worked in your life to be able to make sure that you're returning capital to your investors. That's really an important time to get in, because once a fund hits their max capacity, their LP base really will not change, right? So that's when it gets really hard to get into those big firms. And you don't want to wait as an LP, you don't want to wait till that happens, because then you might not be differentiated enough to be able to continue to get into that fund. I'll stop there. I love it forever.
I know. I'm so excited. There's so many places we can go. And I just want to remind people that we're going to be taking questions in 15 minutes. So if you haven't already, please use the Zoom dashboard. And of course, my wonderful teammate, Christy, is already reminding you, don't forget to share out what you're learning from Heather, because she has so much wonderful advice. I actually want to talk about a Forbes article that you wrote in September of 2022, because I found it so helpful. You talked about why to invest in emerging managers when public markets experience so much volatility. So with the current state of the markets and some of the stuff that you just talked about, why do you think this advice still holds so true?
So if you're an emerging manager, you're investing in founders. I'm talking about early stage, because I'm early. I'm first check-in, pre-seed, seed. We do some builds as well. So you're investing for a world in which we're living in 10 years, 8 to 10 years. Your exit environment is also going to be 8 to 10 years out, which means it's just going to look very different. And if you look back in the cycles right now, whether it's 2008, we had the financial recession, and that was an opportunity to invest. It feels like you have to zig when everybody's zagging, and it feels like doom and gloom, but that's when the founders who really know where the problems are come out. That's where, you start to really see a shakeout of, of kind of the inflated values and things. So you make your money when you buy. So if you are in a time where it's not obvious to where you're investing and you see an opportunity, that's generally in 5 to 10 years, that's where the value is going to be created. It's too late once it's obvious. Then by nature, everybody knows there's a lot of capital in the market and, in the opportunity. So you really want to be ahead of the game. So I think it's analogous right now of that time, both if you have the capital to invest in founders, I think it's going to be a really interesting vintage. And if you're an LP and you have capital to invest in emerging managers who are seeing those opportunities, it's a really interesting time. So you have to, as an emerging manager, be thinking about where the world's going in 10 years. And I think that's like very long. We play in a very long-term game, and you can't be a short-term thinker. You're not mapping to quarterly earnings. You are mapping to building value. You're creating value in these companies. And so I think thinking about fundamentals of the business, kind of going back to that, it's not growth at all costs. It's definitely thinking about how founders are being really smart about how they're going to make money. It's like, who's going to pay for this? And going back to basics, which I think the tech industry has gone a little far from.
Let's dig into this for a second. By the way, Heather, I'm having so much fun. And so I just want to know in the chat, like, how are you all feeling? How's this hitting for you? You've been a little quiet today. I like to have noise in the chat. So let me know if this is hitting for you. Heather, it's hitting for me. And I want to talk to you a little bit about how founders can be smart about building value in their company, because I know we do have founders in the audience. So what's your advice for founders as they think about building their company at the earliest stages to not just create value, but make money as well?
Yeah, I mean, I think the venture capital, and I've been trying to think about how to articulate this. There's some people Sam Lessons talked about this from the information. I mean, the game of venture capital, I'll call it, has been for quite some time when interest rates were low, money was essentially free. The game has been, how do you price a company so that the next round of funding can realistically make sense and come in and keep the company alive to be able to figure out what their business model is. I fundamentally believe that works for some people because you have some companies that will work and be really big returners. But when I started, my father was an entrepreneur, my grandfather was an entrepreneur. When I started this, my dad said, "What value are you going to create in the world?" That was my mandate. It wasn't like, "Oh, what job are you going to get?" Or it's what value are you going to create. So I always look at what is the company fulfilling what need, and is it really servicing something? We call it the human needs economy. Is it a need to have, not a nice to have? And are you going to be recession proof essentially, or an essential to somebody's life? This is just our lens on it. But I do think that the founders have to think about, are people still going to pay for this? And when they don't have, copious amounts of disposable income, or there's a recession, or there's global turmoil, or any number of things that we just experienced in the last 6 years, every year it's something different. So, I think that you really have to think about that. And then sometimes that's non-consensus. Sometimes it's not the buzzy AI, chatbot, crypto, whatever, that seems like, oh, everybody should get in on it. If everybody should get in on it, it's too late. And also, like, that hype is just, you're putting a premium on something that might deflate. So you have to be really kind of in a silo and say, is this creating real value?
Heather, what you just talked about, and I know you've seen so many companies at this point, right? The companies that you vet, then the companies that you invested, and then the companies that have success and those who don't. What are some criteria or maybe some characteristics that you see in the companies that are out there to generate value that is defensible despite what's happening in the market or the world?
So we talk about doing the hard thing. What is the hard thing that the founder has to do in order to make it so that it's defensible and they have kind of a leg up? Sometimes it's not obvious what that is, but whether it's contracting with a bunch of customers that have exclusivity or contracts for the next 3 years, negotiating those contracts, or sometimes it's there's a ticketing company we looked at, and the person running it has made, with personal relationships, has gone into 2,500 different promotions and clubs and things. It's like there's a hard thing that you're doing that the founder can kind of point to that makes it something that you can build off of. Too often, I think the tech industry has kind of like used a playbook to talk about the way that they're building a company, and it sounds and looks a certain way, but everybody can do that. There's so many off-the-shelf products now, and being an engineer is no longer, a defensible kind of moat as a founder. So I'm not going to say the tech is a commodity, but it is much easier to build than it used to be. So what are those things that are, a hurdle that the founder has already done, or you think they're uniquely positioned to be able to do? And we look for that type of founder, and that type of founder is a little, there's a motivation there that's a little bit different than most people, and they have a risk tolerance that's a little bit higher, or they know how to navigate ambiguity. They know how to sell their vision to employees. They know how to sell their vision to investors. But it's not just storytelling. That's a big component. It's also then execution and backing up. And a lot of times you'll see founders kind of go over their skis in terms of how they're selling. That's good. And then backfill, you have to see that execution. So we call that build velocity. And that comes in a lot of different packages that, quite frankly, I think a lot of investors haven't been able to place a value on. So it's not, oh, they were, at a top 10 company that was backed by a top 10 firm. They went to a top 3 school. Therefore, that's a founder profile we should invest in. I think that's outsourcing to too many filters and heuristics that are not differentiators anymore. And you're not going to find arbitrage or alpha in that. So I look for, how are you evaluating founders and the way that they're building in a world where everybody can see the other premiums that are placed on the profile that I just said.
Oh, okay. Listen, folks, that we don't have enough time with Heather. We don't have enough time with Heather. If you're not taking notes, please make sure you are. We have 5 minutes before we head to audience Q&A. But before we get there, speaking of alpha, I want to talk a little bit about the new term that you brought up in your article in Forbes, which is alpha generator for emerging managers. So what does this term mean, and why did you land on it?
And there are a lot of really good suggestions from other people around this too. I love the term alpha generator because some of the funds that were kind of emerging managers that were creating alpha are now in kind of a different phase in their maturity, and they are creating like a consistent return, but it's definitely a different return profile. So I like this term because it's kind of showing when you feel that it's difficult to raise your fund, it's non-obvious, you probably have something there. And if you can get it raised and deploy it and it works, then you're creating that alpha. You're early, and it's by definition, you're always going to feel like it's difficult to raise. And if it's really easy to raise your fund, you might want to take a look and say, am I like differentiated enough? Or am I forward thinking enough? Because it was kind of the immediate zeitgeist. And so you better be forward thinking. So in my mind, the alpha generator is really just somebody who sees the world in a different way, and they're executing on that. And then they're able to find the founders who also live in that world, right? But you have to bridge the gap because allocators are kind of in the now, right? So they're 10 years behind that future that you're seeing. So you have to convince them and bring them along.
So it's interesting because one observation that I've made, having worked with so many founders at this point, and then now talking to so many investors, especially emerging managers, I've noticed that it feels very similar when I talk to both of them about how hard it is to raise. So you just talked to me about what a founder can do to communicate, not just through storytelling, but execution, how they're bringing value to the world, how they see the world 10 years from now. What do you think emerging managers or alpha generators can do to effectively communicate that vision that they have for the world 10 years from now, and how they're not just going to tell a powerful story, but actually execute by finding the best companies out there?
I hear this time and time again after talking to all the LPs, like right now it's more important than ever to really articulate why you should exist, because there are so many funds. Why didn't you just join another fund? Why aren't you, why should you steward capital to make money for people? And that's quite frankly, like when you make money for people, people will give you more money. Like it's just, that is how it works. And sometimes you have to have that gap there. People have to take that leap of faith. So articulating the differentiation, and I'm not saying that we have that figured out. The landscape's changed. When we first started, we were kind of the only game in town in New York. Now, like there are a ton of New York focused funds, right? So I have to sit there and say, what's our unique differentiator? If somebody doesn't know that we've been here forever, and somebody doesn't know our power of our network, and it's really hard to tell those things that are kind of intrinsic. So you constantly have to be hitting the refresh button on how you're telling your story, and the path of least action to trust is really important.
What do you mean by the path to least action of trust? Can you dig into that for a second?
Yeah. So if you're talking to an investor who's going to invest in your fund, who do they trust to validate what you're saying? And can you get that kind of external reference to be able to say, oh, okay, I already have a pre-existing relationship with X, Y, and Z. I respect the way that they invest. If they've invested in this person, that allows me to give that credibility, kind of take that shortcut. And so I think that's a big thing, because you have to articulate something in a short amount of time with a timeline, and be able to create that trust with a partner who's going to be with you for 10 years.
Yes, I love that so much, because so much of what we talk about in our industry is really rooted in trust. Do I believe what you're saying? Do I believe that you're going to execute on this vision? Do I believe you're going to find the right founders? Do I believe you're going to return capital? So looking for those points of validation so that you can double down on trust. I think, I love that advice. All right, folks, it's 9:59 and you might see it. I don't know, Heather. We've already got questions popping up in the chat. So just want to let people know how I like to run this portion. I take questions out of the Q&A dashboard. So if you're having trouble there, feel free to reach out to Christy. She'll take care of you. What I'm going to do is jump in and start pulling questions out. I'm going to call out the person's name. You can also submit questions anonymously. So I feel like people don't need to know my government name. That's fine. submit anonymously, and I'd be happy to get to your question. And I'm going to get to as many of these as possible. And then Heather, I'd ask for you to be as pithy as possible, which you always are, so we can get to as many questions. So let me get in here really quickly. I see that Emily Gendron says, recent portfolio configuration studies have found that funds 1 through 4 return the most. How do you square the obvious upside with reticence to invest in emerging managers? In your experience, besides warm intros and track records, what gets LPs over the hump, if not the data? By the way, very well written. I just wanted to compliment.
Yeah.
That was like a complex question, but like, Emily, 10 out of 10, no notes. I'm going to drop that in the chat so we all know what we're talking about. Thanks, Emily. Go ahead, Heather.
This is the $100 billion question. I mean, it's so interesting. I think right now LPs are being challenged to say, it's not obvious who's going to emerge as the next big fund.
Pun
so
intended.
You have to do your
Sorry.
so you have to do the research as to say, what types of profiles of managers do you think are going to attract the next types of founders who are going to usher in the next phase of innovation? That's a big one. What's the background there of those types of people? And if you base it off of what you've evaluated in the past, you're not going to get the same results going forward. We've just moved too much as a society, as a nation, as needs and wants and everything. So you have to update your model as to thinking who's going to be successful in this business as an LP. So this is the rub. I think you need to find people like pensions. You don't want them taking risk on some of these solo GPs, who have a podcast and then decided to raise a fund. No knock on that. They have an edge. They can blow up their company, whatever. They can really make a difference for their portfolio companies. They add value. That's good. Maybe they don't exist in 5 years. You don't want to take that risk if you're managing a big pension fund, and so you're what they call underwriting this manager for the next 3 years. You want to make sure that they're steady Eddie, even in their big swings that they're doing, right? So I think it's a really reasonable thing for some of these LPs to wait a couple of fund cycles to see whether or not you're going to do what you say you're going to do. There's partnership risk too. People don't know that when you start a fund and you're kind of, it's like a marriage for at least 10 years, you have to make sure that you can work with this person. And it's easy to put your faces on a deck and like looks good on paper, but the chemistry is really important. We have Esther Perel as one of our advisors because she understands relationships. And we did a whole guide on how to find your co-founder. Like, what questions should you be asking? Because people are doing business with people, not your resume. And people forget that. So it's really hard to interview a partner. It's like finding your mate. So you have to make sure as an LP that you're investing in partners that aren't going to blow up, right? So there's a lot of risks for emerging managers. And I think that it's right for some of those pools of capital to not take that. Now, there are pools of capital that like fund of funds or emerging manager, like dedicated funds, family offices, people who have made their own money in their family business and understand what it takes to actually build a firm and start a business from scratch. They're more inclined to take that risk because they're more inclined to have that same value perspective, and they can evaluate founding fund managers, quite frankly, in a really, really apt way. So I don't know if that fully answers the question.
But all of your answers, there are so many. And I think what I'm also interested to hear, and I want to push on this a little bit more, is like, are there any other ways that people can get over the hump with LPs if they don't have enough data in the beginning?
Yeah, I think you can't treat all LPs the same in terms of the profile. And if you get a no, you can't take that personally. You have to say, was that your kind of buyer? So I always say internally in the team too, it's like, find your buyer. Because when it clicks and people understand the value that you're creating, it's really obvious. And then like, are they deploying? Do they have capital to deploy? All that sort of stuff. So let's say everything's vetted. They have capital to deploy. You're in their sweet spot. Now, do you resonate with them? So some LPs look for people who went to Harvard, people who worked at X, Y, and Z firm for 5 years. They spun out. They're starting their own fund. Like, I'm never going to check all those boxes. I'm not a traditional background by any means. Now, like I said, if somebody has made their money in inventing Gorilla Glue or has like family business that's X, Y, and Z, and then they see what what we've built from nothing, and they see that what network we've created, and they understand how people work and all that sort of stuff, then they're more likely to resonate with my story. And then it's just, did they do what they said they're going to do? Have they returned capital? They just kind of go through all of the diligence. So I think it's really understanding who your buyer is and making that category. And then if somebody does invest, profile that category and say, now how do I find more of those types of people?
I love this so much because, again, I keep thinking about, for founders who are here in the audience, two things. Number one, it's so good for you to understand how firms work, where they get their money and what they're looking for, and also like the challenges they face and what the job to be done is for them. But then also, I just want to draw the parallels. So much of what you've talked about is so applicable to founders building great businesses, right? Finding the right customer profile. So I'm loving it. All right, let me get to my next question here. Marissa, I love this question. This is a little bit about taking on a role. So what advice would you give to a candidate interested in working at an emerging managers firm versus an established VC fund?
That's a great question, Marissa. I think, you have to just know what comes with both profiles. So a firm that, is established and they're on fund 10, 12, whatever, they have a internal team that raises those funds. You'll do less of the fundraising. You'll do less of the, kind of building out the actual firm and brand and things. An emerging manager is working off of very little capital. Like people think, oh, fund managers have this big pool of capital and they spend this money and everybody's rich. No, like you are actually the fund manager. The economics are usually 2% management fee per year and 20% carry. So carry means like if your company does well, the companies do well, and you're returning capital to your LPs, then you get money too. So your incentives are aligned, but you're not doing this for a short term. Paycheck, you're doing this for long-term value creation and paycheck. So you have to understand that building an early firm is that. So you're going to expect, smaller salaries in a big fund. You're going to expect to wear more hats. You're going to source and due diligence and help with brand building and how, there's just so many more things that you're exposed to as working with an emerging manager, which is really, really good. But then there's also, it's less of a platform. You have to kind of build your own, you have to be more entrepreneurial, I think. And so if, what advice would I offer? I think it's, what do you excel at and how are you going to create, outside value for whatever firm you're with? And then how does that firm value their kind of employees as well? So do they only hire people who are out of Ivy Leagues? Do they hire people who are more founder focused? Do they hire people who have big networks? Are they, a firm that's quiet and have no presence? Or are they a firm that really likes to be larger than life and kind of their brand is even bigger than their firm? So I think all those dynamics.
Thank you so much for sharing. And I'm just want to let you all know, like, this is probably the most active Q&A session we've had. So Heather, lots of love already. I'm going to take it over to Mary. She says, what is your advice for folks who have worked in high growth, early stage startups, but want to transition to working for a fund?
It's a great question. I think there's a big debate right now in the venture ecosystem about platform or value creation post investment. So support, are you helping the founders? I think some people think that funds can move the needle for companies. Obviously, as an early stage investor, and we really do think that. We say, when we make an investment, can we help move the needle for the founders? And then at first 6 to 10 months after we make the investment, we're not just money. I think that's important to know whether or not you think you're somebody who can help companies, or if you're like, I just don't want to be value subtract. I'm going to give you the money. I'm going to be quiet. I'm not going to, So I think evaluate which fund, like what their ethos is. And then, I would go to a fund that is the former, right? Like if they do pride themselves on adding value post-investment, if you're an operator, clearly you're going to have a lot of value in that fund. So just see what their kind of ethos is, and then see what portfolio companies they've invested in. Is that, are those categories something that you have expertise in? Because if you could go to a fund and you can say, I helped with partnerships for the company that I was just in, and I helped grow that company from X revenue to X revenue. This is what I've done. Like, I can do that for a subset of your portfolio companies. Like, that's a no-brainer for a VC to say, like, oh, that makes a lot of sense. You're going to actually create value once you start coming in, and just making sure that the work that you're doing is valued by those partners if you're not a non-investment partner.
Mary, I hope what you post in the question is also a flex for you. And if so, I'd just like to celebrate that. That sounds awesome. Yeah. All right. Heading on over to one of our regulars. So happy to see you here. Pian Pian says, what do you look for when making pre-seed or seed stage investments? What information do you need to see for execution?
Oh, this is a loaded one. I'll just do a couple. I think one is, we talked about this builder profile. What have you built in the past as a founder that demonstrates that you know how to get something from 0 to 1? It doesn't have to be huge. It doesn't have to be venture backed. It just really has to be, you knew what the hard thing was. You went out and did it. I also don't discriminate if you built something and it didn't work out. That's a lot of knowledge. There's a lot of variables. Market, was the customer, like, what did you learn from it? So definitely learnings there. I think the founder market fit is more important than ever when it's pre-seed and seed. So do you have a unique lens on this industry, or the unique tech that's going to be built out to be able to make this win, or the network that gives you some sort of a moat? There's a lot of people who start companies and this is controversial to say, but like, who shouldn't start companies? Like, be very intellectually honest with yourself about, and I'm not saying that, like, I think there's a lot of people who have imposter syndrome and they should start companies and you should go for it. But I do think you should say why, just the same as I'm talking about differentiators for fund managers. Why should you be the one to start this? And is that going to really set you up for success?
Yeah, I just want to say, Heather, when I started a gifting company, somebody asked me that question and I took deep offense to it. But they're right to interrogate that. And so I just want to say to any founders here, if you're getting that question, be deep, get deep with that, and try to be as intellectually honest as possible. Yes, why should I be the right person? Especially because my friends and family would tell you, I'm terrible at gifting, Heather. I've been working on it. The business helped me become a better gifter, but I didn't have a unique lens on gifting prior to that. So I think that level of self-awareness is so important. And I'm really glad that you brought that up. So yeah. Feel free to take those kind of questions, folks, and keep it very 100 with yourself. All right, great question. Let's head on over to another wonderful question. I want to hear from Victoria. She says, what about startups that are making new markets? How do you get beyond financial value and see broader societal value that a startup can bring? And how do you evaluate that and think about assumptions around future expected financial value? Just some tiny questions, Victoria. You're bringing us tiny questions.
It's a key one. That's so smart. I mean, if you must be an investor, you must think about this all the time, or a founder, because on face value, there are very few markets that are venture backable. And this is a thing that really bothers me when investors will sit there and say, oh, this is too small of a market. Okay, well, is it a too small of a market, or did you not think that founder knows how to capitalize on the markets that are going to be subsequent markets that are going to be created because of this? So I'll just take women's healthcare as a general, lens in the beginning. I think when we started investing in 2015 around women's healthcare, everything felt too small of a market. We have a company called Paloma Health, and that's in the hypothyroidism testing, diagnosing, and everyone's like, that's a very small subset, and how much money do people really pay? And now, if you can do one thing really well, then you can land and expand, and you can start to then, pile on care economy and, all the tech that they built for this. And, Evie is another company that we invested in, and it's sequencing the vaginal microbiome, and it's a consumer kit that you get, it's a subscription every 3 months, and you have this baseline, and people are like, okay, it's a consumer company. No, they're now sequencing data that's going to be worth so much to pharma, to everything. So you can see where founders, what I look for in founders too, is how they're understanding their problem set immediately. It probably is small, do it really well, and then understand where you can continue to expand. Carolyn Witt from Tia Health started as a chat bot for, asking for advice to your cool Aunt Tia for birth control and things. Then she started to see, wait, actually, there's no, place to even go. People can't get to a gynecologist. They can't even get anything for women's health. There's no space for just primary care for women. So she kept on expanding what their product offering was and created a whole new market. So I think you have to intellectually see, a lot of times you have to take a faith on the founder that, as an emerging manager, I say, I can't be 10 years out. That's what the founder's job is. Founder's job is 10 years out. I'm like 5 years out with my thinking. And if I can extrapolate, okay, they can think about where they're going to grow this business past the immediate need that they're filling for the next 5 years. I think they'll be able to do that again and see where that goes. For all the kind of difficulties that Travis Kalanick had at Uber and everything, one thing that they did do was, okay, they started with a really niche, black cars, whatever. Then they started to see where that was going and it became a completely different company. No company is going to end up where it started. That is a big success. It's just, you have to have the mindset of continuously growing into new markets. I don't know if that answers your question, but for us, it's evaluating the founder, whether or not they can be like visionary enough to capitalize on it.
Yes. I love it. Great question, Victoria. Thank you so much. And great answer, Heather. I'm heading on over to Aisha's. Aisha says, as a Black female founder, it's been difficult for me to find investors. Black women are the most founded and least funded, receiving only 0.34% of funding. I do not have a network of investors. I'm a med tech founder with 4 patents and 13 pending. Come on, Aisha, tell us. I bootstrapped today and am now raising seed funds. So talk to us a little bit. What advice do you have for Aisha and other folks? Because we know this stat all too well. And as you can imagine, not thrilled about it. We need to fix this. This is unacceptable.
Yeah, definitely. I mean, it really is. And whether it's the category that you're in that's too nascent, or it's the demographic that you're representing that people don't have pattern recognition in enough, or I just see it all too much. And as a founding fund manager myself, have come up against this a lot. I think, all I can say is that the market is definitely shifting, and those numbers are really disheartening. But if you look at kind of the emerging manager landscape, and this is why the title of this is so apropos, the emerging managers are in a position to really move the needle on this. What needs to happen is multiple fund cycles for these emerging managers to increase their fund sizes so they can increase their check sizes. Proportionately, then we will have a lot more funding going to these areas and founders. So that's a long way of saying there are a lot of emerging managers who focus on these areas and who can understand the profile of founder that you are, because they've had to create that niche opportunity for themselves in order to create value, right? So more than ever, there are funds dedicated to, female founders, women of color, areas like this. And I love that you bootstrapped it. The patent pending, those are the hard bangs. Finding your buyer is really important, and then understanding what networks they have access to is really important. Because again, once you get into one investor who said yes, you have a market opportunity there. That means there are going to be more other people who are going to understand that market opportunity. So you just have to understand that first investor and the way that they think and the way that they are networked. And then that starts to unveil other investors along that path. Not easy, totally get it. But those are some of the kind of tricks that have worked for us.
Thank you, Heather. And I should keep going. We're cheering you on. And we want you to be wildly successful and keep us updated on how it's going. I see Sanjeev says, happy to chat with Aisha. Okay, Sanjeev is using the Q&A dashboard. He's like, listen, I'm ready to talk to you. Okay, folks. This is why I said, Listen, you got to shoot your shot while you're here. All right, so I'm going to head back to another question that I saw. Actually, Sanjeev, this is your question. I'm an emerging manager. How do I attract talent to work at my firm? Great question.
Ooh.
And you got some great talent, Heather. Let me just say, the folks over there at Human are top notch. So go ahead.
Well, I'll just say how we have done it. Like, we have different ways of finding founders. We also expand our ways of finding really talented people. And, the woman who I think you're referring to, Elise King, who's just phenomenal. She was a founder. She worked at a studio. She did recruiting. She's a professional dancer. Like, the way that I always say, you can teach the technical skills of investing. You can't teach a lot of the EQ and the way that people are evaluating things that could be different. So I like to bring in people with human who are similar. They're good builders. Like, who do I want them to find as a founder And do they exhibit those qualities? So if I hire only MBA grads from XYZ, top tier, whatever, they'll be looking for MBA grads who know their, you just like the talent that you bring in will then find value in talent that's similar. So think about how you want your network to expand and how you want your view and lens to expand, and then start like creating, noise around your value prop. And people do want to work at Human. We're not a huge fund. We're not a big, but I get so many inquiries. And I think it's also because what we put out there resonates with a certain type of folks. So anything you write, a tweet, a LinkedIn post, a Forbes article, anything is reflection of the way that your firm thinks. And it better be consistent with how you act internally, because a lot of people have like a view of what firms look like. Then they go in there and they're very different. The way that they operate is very different. And they're like, oh, you just hired a branding agency to say that you cared about this, this, and this, but that's not really how you operate internally. So I would really vet those firms. I would say, as somebody who's looking to be in venture, you see people who have left and see if that's really how they conduct business. Somebody who's attracting talent, I think you have to be really, just like you're finding founders, you have to find unsung heroes and give them a platform to be able to grow. So growth is something that we absolutely value at Human. Like if you're not growing, you're not alive. And so you like have to be somebody who's growing. Now that's tough because we attract really ambitious people. They spin out, they go and start companies, which is awesome. But then you have to redo it. So you always have to be kind of finding those talented people and cultivating them.
So you're attracting the right people because you're putting out those signals that are very values aligned for you. Like you're like, this is what we say we do. This is what we say we care about. And this actually is what we do and what we care about. So you're bringing that. And yes, I was talking about Elise. She is just incredible. We're so grateful for her.
She's so great. And every day I have to sit there and prove our value there. Because like, yeah, can get poached any minute, right? Like, and I do. Some people have like the best compliment ever. People will tell me like how great the people are that work for me. I think that's the best compliment ever. You always have to give them, you have to give them opportunities so that they know that they want to stay there. And that's a risk.
Like this. Listen, I feel the same way about my team. Listen, we got great people around here and they are doing big work. So we want to make sure they're happy and give them lots of great opportunities. I wanted to come down here and talk a little bit about one of the final questions that we have, which is Emily's question. She says, love the long-term thinking. What deltas and macro trends are you seeing between now and 10 years from now? Ooh, crystal ball time. Go ahead, Heather. Let's go.
Okay. Nobody knows what's going to happen. What I do know in my personal feeling is the undervalued changes are really the human changes. So, in our industry, we have a lot of prophets of people thinking of Asimov, thinking about where tech is going, frontier tech. People have predicted AI for years and years and years. Like there are a lot of people who are thinking about that. In some of these books, there's still, women are baking space pies and nobody contemplated identity changes and nobody contemplated unconventional structures of family or all the different ways people are having children or fertility issues. And so like the human issues are what I love and I'm a student of. And then you start to think, okay, if we're in a world of 20 billion people, what does our day look like? What's different? And what are you consuming? And what are you viewing? And if you're in a world where you have infinite access to information at your fingertips, what's now valuable, where information used to be really valuable? Now it's everywhere. Now curation is very valuable. So we do these exercises at Human of just what are the life stages, because those aren't going to change. Everybody has their life cycle, right? Whether life expanding, life stage is expanding, yes, but you go through this arc naturally as a human. And in each one of those areas, whether you're, in your education phase, your career seeking, what are the changes that are happening in the next 10 years? Are secondary education going to change? Is certificate education better? Upskilling? Like, can you take 2 courses and then get, an increase in your job that's better than going to a 2-year university? Like, there's so many things that you can change, but I'd say take a stance on something like that and then see what the world looks like and through that lens, and then what the commercial opportunities are near term.
I just want to point out, or in the next 5 years, right? I just want to point out that I did hear you bring up Asimov. Cool. Got that book on my desk right now.
Cool.
I was like, okay, I'm starting to see the science nerd in you, and I love you. Science fiction is I have a lot of Octavia Butler up here. So it looks like we have a book club that we need to kick off. I have one more question that I want to ask. Go ahead. Come on.
Oh, I was just going to say one that I just, it's kind of a young adult one. It's called Red Rising. That's one that really talks about, it's sci-fi, but it talks about class and structure and power dynamics that I think are more important than ever right now. And people miss that. And so I think that's one that I, again, like student of EQ, student of, Murderbot, new one that's coming out. That's another one. Yes. The sci-fi that talks about the humanity stuff I love.
Heather, I want to apologize in advance for every text message I'm about to send you for my insights about Red Rising, Murderbot, which I didn't even know about. Rachel and Octavia Butler in all caps. So please block me. I just want to advise you now. All right, I have one quick question to ask you before we wrap up, because I think this is a really great one, especially shout out to our associates in the room. Marissa says, how can associate level individuals support emerging managers with LP fundraising?
Oh, you're so great, Marissa, because you know what's on everybody's mind. I think it's difficult. I think really showing opportunities for investment, which I know you've done a really great job of showing opportunities for fund managers and being able to articulate why and having those conversations and being patient with fund managers who might not be able to hire right then, but you're having that dialogue and you're understanding how they think. I think it's really hard to help with LP fundraising when you're not a part of the firm or you're not the one who's selling it. It's even hard for funds 1, 2, and 3 to have kind of an external party help you raise capital, like a placement agent or anything, because you're really selling yourself. You're selling your vision and you're selling yourself, as a manager. So it's hard for other people to do that. So I'd have to think about that question a little bit more.
Look, it's 10:26. I know that time has passed because we've been having a wonderful experience together. So first, I just want to thank you for being here, Heather. We know that you're very booked and blessed, but you made time to be in the room with us. We have 2 final questions for you. Number 1 is, can you share one final piece of advice for our audience?
If you're in this industry in any capacity, make sure you're working with people who you respect. If there are senior people in your firm, you want to be them or an aspect of them in the next 10 years. Like, people are everything in this, so don't compromise that. If you feel that people have compromised values, but they're making a lot of money now, it's going to play out. Like, there's just, it's going to, hit the fan at some point. So it's not worth it. And I think really, really resist the urge to go where the mob is going. So if you think that it's cool to be talking about X, Y, and Z, it's probably not. Just really have your own unique perspective and be okay being different. I think that's a big part of this whole business is, if I'm too much the same as other people, I feel uncomfortable, and that's probably, my edge. It's like, I always want to be kind of an outsider because that means you're thinking about things differently than everybody else. I think that's really important to hold on to that. So those 2 things, work with the people who really, sometimes that means compromising accolades or pedigree or whatever. If you're working with people you love and you want to make them money, you want them to make money, you want them to succeed, it's so much more fulfilling in the long run. I'll say that.
I feel that about your firm. I'm so grateful for you. Thank you for sharing it. Yes, people are. Everything does. My last question for you is, Heather, how can we support you? How can we be helpful to you right now?
Well, this was lovely and so unexpected. And thank you for giving me this stage. And, if you like some of the things that we put out there, we don't have a big marketing team. We're a very lean team. I don't have a PR team. Help spread the word. I think it's easy to kind of nitpick and think where people are doing things wrong in this industry. I think if you're a champion for other people, it can only come back, if you really like something, it can only come back to you in a good way. Surround yourself with people who understand that dynamic. And we do, I never forget an intro that somebody made. I never forget, somebody who helps. I I love that reciprocity ring. So, yeah, I think giving without expecting something in return will, if you're giving to the right people, will always net a positive return.
Well, I hear you. We're going to help spread the word. With that, we'd like to release you to go and do more things today. Grow a person, grow human ventures, take care of yourself. Heather, thanks for being here.